everyone was saying it's going to be a big crash and property was going to drop by 40%. Now, the 40% drop didn't happen. So the big question is this: how are investors like us who weren't born with a silver spoon successfully investing in property to create a passive income and still have a lifestyle now? That is the question. This podcast will give you the answers. I'm George Markoski and welcome to the Positive Property Show. Our mission is to empower 10,000 people to create financial freedom through property using the Markoski method. Join us. Hey guys, how you doing? Welcome. Now, George Markoski from Positive Property. I'm here with David Lipschitz from Logic Finance.
If you can hear me okay, happy to talk a bit more about what's happening at the moment in the market, because this is, we've never seen anything like this. Money is so cheap at the moment. And, I've even got clients right now that are saying, I've got cash in the bank, but I might as well borrow. It is so cheap and it's such a great time to get into investment property. Used to be the time where, remember the days where we used to have interest rates of 7, 8, 9%. Those from 30 years ago probably remember that 17%, but
yep.
Back then you were still a line ball. You had to go, well, actually, how much capital growth am I going to get? How much am I going to get this? You look at all those sorts of things because really the rental yields generally still sit about, like you say, 4.5% to 5%. Now we're getting interest rates at 2%, right? Half the rental yields. So it's extraordinary. And not only that, banks are sort of clamoring over themselves to provide rebates and every type of angle to try and get market share. So it's a really good opportunity for investors to get into the market. And as you say, this is, we're seeing all the hallmarks of an extraordinary property boom going right now. So, and I dare say the low interest rates are playing a role in that. But if you look at all the fundamentals, particularly with what's happened with the economy, what's coming out of COVID and so forth, and certainly the medium-term fixed interest rates and so forth, there's no talk about them going up. No one's talking about them going up, right? So clearly, even if you were just looking to invest for the next 5 to 10 years, this is a great time. There's some certainly a fair bit of stability over the next 5 years from what I'm seeing within finance circles. So obviously, great time for property, great time for finance.
Absolutely, absolutely. Now, look, guys, I've got David on tonight, and he's here to answer your finance question. So David's here to answer your finance questions. So please type in any finance questions you've got, because David's going to be able to help you with that. And as David was saying, it's pretty full on. Look, this is the thing, right? The models that the banks are saying, they're saying that prices are very quickly going to go double digit and stay there through 2021. This is actually the biggest boom since the GFC. Even leaves, back in, if you remember back in 2013 and 14, the big mining booms, right? Leaves them for dead.
I'm going to answer a few questions here. First one will be on the 1.99%. We were talking about the rebates before, about a whole heap of lenders paying rebates. The same applies to a number of lenders really trying to buy market share with interest rates. The only thing to bear in mind is a lot of these, consider them like a honeymoon rate. There used to be, lenders used to call it for what it was a few years ago, where they said there's a honeymoon rate and then it's just going to go up. They're essentially trying to buy some market share by allowing you to get in really cheap early on. And then as soon as you've done that, then the variable rate will sort of push it up. So just bear in mind, if you're getting those 1.99s, that are great, but just in 2 years' time, or whenever that rate expires, you really want to review it and have a look at what else is in the market at that time. If it makes sense. But if you're looking to build a relationship with a lender, you want to see what their ongoing rates are as well.
Yeah, look, personally, I always like to go for a broker and not go direct to a bank anyway, because the one challenge when you go direct to a bank is the bank's interest is only to sell you their products. And at the end of the day, I want the person I'm dealing with to be working on my side, the team. And that's why I like to get a mortgage manager or a broker so they can represent me, not the other way around where they're representing the bank. Because when you go to a bank, the banks get represented by someone that works for them. There's another question here. Here we go. So that question about the 1.99%, that was through CBA, wasn't it? That question? Because CBA, I know a few people where they've cross-collateralized and I wasn't very happy with the way I did it. I have savings to buy investment. Where should I buy to get maximum returns? I'm wanting to plan for retirement and wanting advice and guidance on what to do. Okay. That's a very good question. And I'll go into this one. Where you need to buy is there's 16,000 suburbs in Australia. And out of the 16 suburbs, there's suburbs at the top and suburbs in the bottom. And what you want to do is you want to get the highest performing suburbs. So what I like to do is I like to actually check out demand supply ratio, and I only pick the top 100, maximum top 200 suburbs in the whole of Australia. So that's where you want to invest for the biggest return. And depending on when you want to retire as well, that's the maximum returns. Because if you want to get maximum returns, what needs to happen is you need to be buying for capital growth, not for cash flow. Because when you're buying for cash flow, you're not going to get maximum returns because your property is not going to go up. So one, you've got to get a property that's safe. I'd say capital city or large regional centre, and one that's got got good capital growth. And then the structure is where you can get it right, and that's where you need a mortgage manager or a broker instead of a bank to get the structure right. So that way your cash flow is there as well, so it doesn't cost you an arm and leg on the way through. 10 years retirement. Yep. So 10 years is a good time because 10 years is actually ideal. What the number one thing I would invest in before I invest in property, and this is what I say to everyone, is invest in yourself first and educate yourself and really be prepared and know what's going on. See, property investing, a lot of people find it very complicated because they don't understand the core principles and they don't understand the basics. But when you understand the core principles, it's actually very simple. So that's why you need to know that, and that's why it's very important. Look, depending on your assets and your equity, the money you've got and the money and how much you earn, that all makes a big difference in how much you can, what you're going to do for your retirement, and depends on how much you want. Because some people are happy making 100 grand a year, and other people, they want 500 grand a year. So when I originally retired, just to give you an example, I retired at 37. I had 10 properties, and I was making 180 grand a year, passive income. Passive income is when you're sitting around and you don't have to do anything, and the money just comes in. And at the time, that was good for me, but I actually now want to get to the next level. So I'm actually buying a lot more properties this year. And David's helping me buy more properties because my goal is to buy number 4 this year. And Christina, my wife, wants to buy 5. So we're having a bit of a competition. And I think she's going to beat me because she's more motivated than I am. But yes. Someone said, hello, George Markoski. Hello, and welcome. Thank you. Now, I've got someone here for you, David. I'm a CBA customer, fixed my loan just before COVID because I was paying 3.8% and got offered 2.7 for the 3 years, but now interest rate is 1.99. Still 2 years left for the fix to change in offset account, and I fixed all my money. So what should I do to save my money as much as I can? David, can you please answer that one?
So to talk through what's happening with CBA at the moment is these are lenders, like you said before, that a lot of the majors would like to cross-collateralize. So they basically, what does that mean? It means they basically get their hooks into all your properties. And you'd go, well, what's the difference with that? That's okay. Well, it's all very well until you want to sell one, or want to renovate one, or want to change one, or want to get equity out of one. That's when the difference is. The second thing to bear in mind is that CBA might have a really cheap fixed rate, but guess what? They may not lend you the most. Like just to give you an example, when CBA go and look at servicing to try and see how much they can lend you, they only use 70% of the rent. Where a whole heap of other lenders use 80% of the rent, as an example. So their negative deductions are, or their depreciation of deductions aren't too bad. But the reality is ANZ, particularly if you've got a number of properties, is actually a bit better. We just did a comparison with a client that had a number of investment properties. ANZ was able to lend our client about $100,000 more, exactly the same situation. So often it's very important from a structure perspective to look at, firstly, making sure that properties aren't crossed. Secondly, making sure that you've got your cash flow right, that if you want to go interest only and so forth, making sure that you're only fixing properties that you're going to be keeping for that period. And also, there comes a period when you've got a few properties that you might want to start looking at your second lender. Because just sticking with one lender has its inherent risks. The other issue with the crossing properties is it's all very well. Let's say CBA says, well, I'm going to lend you $1 million to do this, purchase a number of these properties. That's all very well and good. But in a year's time, suddenly they go, oh, actually, you know what? You know how we were going to lend you $1 million then? Yeah, now we're only going to lend you 800,000. You go, wait a minute, but I'm in a better position, right? It doesn't matter. So, well, we reassess things, and that's how it is. Whereas, for example, if you suddenly had you could just refinance one of your properties, or you had another lender to go with, you've got a whole heap more options. So I think the key thing is to be flexible, being nimble, having all those tools, getting much like you do, George, getting equity out, being ready, because often those opportunities only come by ever so often. And as soon as they come by, you want to pounce on them really quickly. And
Absolutely.
I know that you and Christine and your team are looking all the time for those opportunities. So it's really important to be prepared. And just one thing I will say, sorry, I know I'm probably just talking a bit of diatribe here. The key thing for me, and the way I see the reason, George, you're so successful, and a number of the people that you work with are so successful, is because you don't leave it to chance, right? You plan, you think about it, you prepare for it. And I think that's how it should be. I mean, there's this talk out there that goes, oh, well, you'll bump into an investment property and then you just go and buy it. Well, not really. You actually prep up, you get the education like you're doing and providing, and then you actually get all the ducks lined up so that as soon as you find that property, that you turn the key and it's not left to chance. You know exactly how it's going to play out. It makes sense. And I think the finance professional is a key part of that, because often when you're dealing with a bank, they're not looking out for your interests. They're looking out for the bank's interests. You're dealing with a broker or a finance consultant, they're deliberately working with you. And by the way, if you ever are dealing with a broker or a finance consultant, ask them one question: how many investment properties do they have?
Exactly.
How many investment loans do they have? Because
You
if
know
they
what?
don't have any, they probably don't have much experience being able to talk from firsthand.
David, that's an excellent point. And I love that question, because I really think, if you're going to get someone to help you finance, and that's why I love you as part of our circle of safety, because you invest in property, you've got properties. But, also, if you're going to get a mentor or a coach, how many properties do they have? Have they done what you want to do? Very important. Now, one other thing I'd like to say is there's a difference between playing checkers and chess, right? And checkers you play when you're 4 or 5 years old. It's a very simple thing, one move at a time. But see, chess is a completely different game, because chess, you got to think 5, 6, 7 moves ahead. And when you're investing in property, when you're doing finance, stop thinking checkers, start thinking chess. Because if you lock yourself in for 3 years, for example, that's not a good thing, because it doesn't make you nimble. But also, if you cross-collateralize, that stops you as well, because we want to start thinking second, third, fourth property at the same time. Because what happens is, if you get the wrong loan on your first investment property, that could stop you from getting your second, third, and fourth. And really, you really want to get the right strategy. Now, what I want to do is I want to go back to the person who's talking about retiring and replying to Facebook. Yes, it's complicated. I want to use my equity and I'm on my own. I earn less than $80,000. Okay, great. Well, $80,000 is plenty. I've actually had people join our program less than $50,000 who have already got 2 investment properties and paid off their mortgage in 4.5 years. And you don't want to use your equity. Well, that may be a lack of education. But this is what I suggest you do. I'm talking specifically to this person who wants to retire and doesn't know where to invest and doesn't want to use the equity. Like I said before, what you need to do is really invest in yourself. I'm actually doing a 14-day live challenge next week, actually. I think it starts on the 1st of March. And in a week or two, what I'd like you to do is type in, if anyone wants to link to our challenge, I think I've got a handful of spots left. Type in challenge and I'll send you a personal message and send you a link to it, because I'm doing it next week and I'm actually doing it live. So what I do in this challenge is we sit down and we go through every step of the process of how to invest in property. I'll show you what to invest, how to structure, and I'll teach you how to create a multi-million-dollar game plan. I'm teaching you how to play chess, and I'm teaching you how to set this up for the rest of your life. And seriously, you only have to do it once. And once you've done it, this is going to serve you for the rest of your life. And if you're serious about property investing, I suggest you do my challenge and really learn about it. So just type in the word challenge, and either me or my team will reach out and give you a link so you can do our challenge. And I think it would really serve you well. You have to be able to service your loan if you use your equity for low income. Yes, of course. And servicing is important. That's why you want to get a broker on board or a mortgage manager, so they can help massage the deal and make sure we present you the right way, because you might present yourself wrong and the bank's not going to help you present yourself right. Is that correct, David?
So I just want to answer this question about the question about should you use your equity or shouldn't you use your equity. That is essentially, that's the gold dust that you've got. If you've got equity, you're in a great position to be able to leverage that. And remember, we're talking about leveraging it at 2%. or something along those lines. So basically, you basically be able to get that equity out of your property at 2%, which is a deposit for buying a brand new property, and you're basically getting it at such a low percent, whereas the actual income that you're going to be getting from these properties are sitting over 4%. So that's the way you're thinking about it. You're actually getting something to invest in, something that's actually going to earn you an income, if that makes sense. And you want to make sure that it stands on its own 2 feet. If you can't afford it, then you shouldn't do it. But I think you should be factoring in the rent, even if you're shading the rent, as a lot of the banks do. You do all that, make sure that you're comfortable. Being comfortable is important. But clearly, with the way interest rates are sitting at the moment, there's lots of opportunity. And guess what? What's the worst case scenario? Worst case scenario is you may want to sell it in the future, if you're really uncomfortable. But really, this is a great opportunity. And I like George's, challenge. I think of, whenever I, had a buddy to go to the gym with who sort of challenged you, that's when you get the best results. Getting someone who's actually just going to push you that little bit further. If that makes sense, George. Sorry again about the delay.
Yep, that's okay. Yes, and thank you so much for explaining that. But look, at the end of the day, there's two choices you've got, and everyone's out there working 9 to 5, or you're either working a job for someone or you're working for yourself, and you're using your time to earn money. And while you're doing that, your equity is sitting at home doing nothing. Right. And a lot of times, when we do our workshops, I ask someone, a plumber will say, hey, I get up at 6 o'clock in the morning, I'll work all day, and I get back at 7 o'clock at night, and they've done, 11 hours or whatever, 13 hours. And I'm saying, what has your equity been doing? Sitting at home doing nothing. So really, you've got to flip that switch, and you've got to think like a millionaire. See, what the rich do is the poor trade time for dollars, and the rich use their assets to make them money. So if you don't want to use your equity, you're thinking like a poor person. I'm not trying to insult you, but you've got to change your thinking, elevate your thinking, get educated, do the 14-day challenge, or get a coach and learn to invest like a rich person, because rich people, they use their assets to make money. So that's what I do. See, last year, I made out of my property portfolio over $1 million last year, and I didn't have to lift a finger, right? And I'm not saying that to impress you, but to impress upon you that you can make money at a property. And actually, this gets me into the next question. At what stage will I start making millions from property? And look, property takes time. I've really had enough of this whole get rich quick, rainbows and unicorns, and all these people out there saying you're going to make millions out of property straight away, which is not going to happen overnight. Property takes time, and you've got to be in it for the long term. And I really think if you're thinking property, you've got to be thinking 10 years minimum investing to really make money out of property. And basically, if you've heard of the rule of 7, if you're getting a 10% return on your investment, in 7 years, it's going to double. So if you buy a $500,000 property and it returns you 10% per year, it's going to double in 7. Now, over the last 30 years, properties have gone up 40%, just to give you an idea. But let's say worst case scenario, properties give you 7%. That means in around 10 years, you're going to double your money. But the way I see it is, I haven't got a crystal ball, so I can't see the future. But, CBA, Westpac, they're saying we're going to double-digit growth just over the next year or two, right? Which is pretty crazy. But I like to look at, 5 to 7%. So that way, in 10 or 12 years, I'm going to double my money. And if I do it quicker, great. If I don't, I'm still happy, because the 500,000 I would have made, I'm still wasn't going to make it anywhere else anyway. So that's really the way it is. Someone says, just say my name, thanks. But you've come across as Facebook user. I can't see your name, so type in your name, and I will. I love it. Now, there's a little bit of delay with me and David, so there's a few little pauses. So what I'm going to do is try to keep it moving and get David back in. So can I get profits from renting property where I'm living at the stage? I'll get David to answer that one.
So I guess there was a number of questions there about whether people are tied into fixed rates and so forth. I think rather than talking about individual situations here on this sort of webinar, my recommendation is get an expert. I mean, you should think of your finance professional just like you think of your accountant, just like you think of your lawyer. Go there and ask for advice on what should you do in those specific situations, right? But I will say this though, the great time, so the golden time to really look at changing up, what your interest rates are, what your loan structure is, etc., is when you're looking to buy a property. So when George and his team have found you a property, and you're basically getting ready to get some finance for that property and getting some equity out, well, that is the time to actually say, well, wait a minute, let's have another look at this, because if we're going to change this, we might as well change the structure anyway. Does that make sense? Because this is the time to do it. So don't miss that opportunity. If you can tweak a few things, clean up a few things, if you need an offset account, you need a few things, that's the time to do it. And particularly if you're going to be breaking a fixed rate, I'd be looking to do it at the time when you're looking to purchase a property.
Excellent. And look, that's fantastic. But what I like to say is, when it comes to structure, right, don't leave it up to the banks to give you a structure, because their structure is going to be looking towards what's going to help them. And don't get someone that doesn't know what they're doing. Don't go to Discount Basement, a mortgage broker who just started his business and he's got 2 clients and he's only been in it for a year. You want someone that's got the experience with property investors and someone that can get the structure right, because the structure is going to protect you. The structure is going to be the thing that's going to help you with your cash flow, and it's very, very important. Now, someone said, can you call Urupinder Singh while you're talking, George? I'm excited while online, please. Look, I'm sorry I can't call anyone at the moment, but if you want to go live on our Facebook, then that's the way it is. So, replying to Facebook user, banks would only loan me around 350,000. Great question. Now, that's because you went to a bank. Don't go to a bank. You can probably get much more. I can't guarantee it, but imagine if you went to David, he'd be able to get you maybe 500, 600. I've seen people, 70% of people that join our program, mentoring program, couldn't get a loan to get anything. And now they've got millions of dollars worth of property. David?
So just to talk about the question about, a bank only being able to lend you, let's say, 350,000. It used to be the case where, all banks were going to lend about the same amount. Big differences between banks, big differences. And particularly when you start having a number of investment properties, the gulf between what one lender lends you and what another lender lends you is significant, right? So don't assume that if you've had a response from one bank saying they're only going to lend you 350,000, that is the go for all banks. Okay, so keep that in mind. And banks, have got their little flavors or their different nuances. Some banks are very good for self-employed. Some banks are very good for investment income. Some banks are very good for if you've got share income, whatever the case may be. So it's horses for courses, and again, get advice from the professional.
Exactly. Or just wave a hand. Okay, I'm going to wave a hand. Hello and welcome. Hello, I want to wave. Now, there's some other news I want to talk about, which is interesting, right? So Australia has actually got a AAA credit rating at the moment that's been reaffirmed by Fitch Ratings recently, right? And only 9 countries in the world have got a AAA rating. Isn't that amazing? Okay, so I've got someone saying, I need a coach. I'm afraid. I know it's long term. Good. Well, look, yes, I believe that everyone needs a coach, definitely. And what I suggest you do is, before you get a coach, you got to check that coach out. Even me, right? I don't want to be anyone's coach unless you know my story, know what I do, and everything else like that. And that's why I created the 14-day challenge. So if you need a coach, type in the 14-day challenge, check me out for 14 days, and then you can decide if you want me as a coach or not. Because I'm not for everyone. I'm very specific for who I help, and I love helping people. But my goal is to empower 10,000 Australians to create financial freedom for investing in property using the Markoski method. We've got over 2,000 people that have joined our program. They're members, and they're currently very successful and very grateful all around Australia who are using my system, and which is pretty awesome. Okay, so here's the next one. So if I get 600,000, how do I service the loan on 80K? That's a good question. I'll start the question, right? So basically, if I'm going to buy a property, I don't want to spend too much money on buying a property. When I first started investing in property, I was spending, negative gearing $200, $300 a week, and it just wasn't working for me. So 80,000 for a $600,000 loan is easy, because if you get the right property, and I recently helped someone get a property worth about $550,000, so I can talk about this. And he was on around $80,000 and his property was positive. So he was actually, how can you service it? You'll be making money. So worst case scenario, it will cost you $30 a week. So the person on $80,000, can you please type in the answer? Can you afford $30 a week? If you can, you'll be able to service it pretty easily. If you can't, it's going to be tough. Obviously, there's two types of servicing: what you can actually use out of your pocket and what the banks say you can and can't borrow. And they're two very different things. And I'm talking, David's the expert on what the banks are going to say. I'm the expert on how much actually can cost you out of your pocket once we do the cash flow calculator. And I'll show you how to use this in the actual, yes, you can afford it. Great. Well, then you can service that. If you can afford $30, you can service it. So what I suggest you do is, one, do the challenge. You can put $50 a week. Fantastic. That's awesome. So you might be able to get two houses, because I'd rather get two cheaper houses than one expensive house anyway, so I can spread my risk. But really, how about the overheads? Yes, good question. Look, when I buy a property, what I do is I'm very, very diligent to let the numbers do the talking, because sometimes people go, okay, what interest rate is it? What's the valuation? Which bank is it? What are they doing and what rebate and blah, 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 blah. Am I paying Linda's mortgage insurance or everything else like that? None of that really matters. There's only two things that really matter. Three things. One, that the property's in a high growth area and you're going to double your money in the next 7, 10 or 12 years. Two, that you can afford it out of your weekly pay packet. And three, you get approved to get the loan. So what happens is, I've got a thing called the cash flow calculator, and everyone that does my 14-day challenge gets one of these for free. And the cash flow calculator, it's worth about $700, and also do the training. And what you do with this cash flow calculator is an Excel spreadsheet. You put in the price of the property, your deposit, your equity, interest rate. It's all orange, very simple. And I'll show you how to use it. You put all details in, all the overheads, and it spits out a number at the bottom and shows you how much it's going to cost you. And when you look at that number, then you can make a decision and go, okay, is this property right for me? And if it's cheap and you can afford it, it's a yes. And if you can't afford it, it's a no. It's a hell no, because you shouldn't be buying it if you can't afford it. Do not overcommit yourself. Do not stretch yourself. Keep yourself safe, because the most important part of investment is, can you afford it easily and can you keep it? Because sometimes people get a bit greedy. They try to overextend themselves. They're paying too much money. Then they get into trouble and they lose their investment and they go backwards. So you don't want to do that. You really want to keep yourself safe.
I will say this, that it used to be a lot more simple, and clearly now it's becoming a lot more complicated, and you can see from the questions that are coming out there. I will say this as well, when the banks are assessing whether they'll lend you money for purchasing an investment property, they actually look at it, they actually work on, even though it's going to cost you 2.5%, let's say, they work on it, costing you 5.5%. Right. So remember that for a moment. So if the bank's lending you the money, they're actually factored in a huge buffer for you, that even if rates should fluctuate, even if things should fluctuate, you've got some room to move there. Right. But that doesn't change the fact that it's worth, making sure that you feel safe, making sure you feel comfortable. We're a big fan of trying to build in a buffer account. I don't know, as are you, George, making sure we've got some contingencies in place. That, even if rent's late for a few weeks, whatever it is, you've got that fallback, so it's about being smart when you're setting these things up, in my view. I just think, the question about the 80 grand, just so we've just recently financed somebody to buy an owner occupied property for 80 grand without any rental income. And it was probably just under 600,000. So guess what? As soon as you're getting the rental income on 600,000, clearly you should be able to afford it. But there's a whole host of other factors, and banks are looking at living expenses and so forth. So I won't jump into all that, but I just want to say that it's worth talking to a professional. And if you've got a rejection from a bank, don't take it as gospel.
Excellent, excellent. Look, we're running out of time. We've actually gone over time. But what we're going to do is we're going to answer one more question. And look, David, you've been a very popular man, and we're going to have to bring you back on, I think, just so we can answer more questions. But what I'll do is answer this last questions, variable or fixed interest only loan when you accumulate investment properties, and why. I'm going to give you my take, and then I'll get David to talk a little bit about it. But really, at the end of the day, I don't like fixing interest, because 9 times out of 10, if you fix your interest, you're actually losing, because the banks have already worked out their little margin and you're paying a little margin to fix that interest. And even the last few years, a lot of people said, oh, George, it's so low, I want to fix. And guess what? They still lost. And we thought they couldn't have lost. So 9 times out of 10, you're going to lose. So you might as well, if you're a betting man, go for the 90% odds and just go variable. Also, I'd go for interest only as well when accumulating investment properties so I can get the cash flow, because I want as many properties as I can growing as fast as I can to get my goal. It takes 7, 10, 12 years for a property to double. So you need to have it. The sooner you get it, the sooner it's going to double. So you want to get as many as you can early on safely so they grow. David?
My take on all this is, and I agree completely with what you're saying, George, is that, the data is out there to say that variable over any extended period always wins out over fixed, always. Right. So now there are those that can get short-term gains. And by the way, the longest you'd ever want to fix is 3 years. Ever want to fix is for 3 years. And at the moment, for anyone looking to fix no longer than 2 years, because really we don't really know. And the banks, if you look over a historical period, the banks have always won when it came to variable over fixed. They're fixed. They'll generally beat you on that. I mean, they've got a whole team of economists working on this. The interest-only piece is interesting because, there was APRA and a few other regulators that got involved and said, okay, they have to be more expensive. They are slightly more expensive. Some lenders, it's actually not that big a difference. But yeah, it has a big impact on cash flow. So really important to look at that, right? So I think these are all really good questions. But I think George is right. I think, if you've got a choice, go variable, gives you supreme flexibility. There's no penalties if you want to break it early, and if and so forth. And getting equity out or moving to a different lender if suddenly they'll lend you more. You can do all that, and you're not pinned down by that lender. And the amount of clients that I've gotten, I see one of your clients, one of the Facebook users tonight has even noted that they're stuck in a higher fixed rate. That's not uncommon, unfortunately. But if you are looking to purchase a property, certainly a good time to review it at that time.
Yep. And look, David and I recently just did a series of videos for the 14-day challenge. And we actually go through and explain all this anyway in detail and give you some homework that you can do. So if you're doing the 14-day challenge, if you're interested, type in the word challenge, and my team or I will send you a DM and give you a link to it because it's starting next week. And, if you're watching the replay, just type some questions in. We're going to be monitoring. We're going to come back, and then we'll have those questions for next week or two when David comes back and visits us. David, I really appreciate you coming on board today. Thank you so much. Thank you, everyone, for watching. Remember, we're freedom fighters. We're fighting for freedom, one property at a time, because I really believe that the life you want, the holidays you want, the family you want, everything you want is one good property portfolio away. It seriously is. David, thank you so much. And everyone have a good night and see you. Remember, we're here live every Wednesday at 6:35 Australian Eastern Standard Time, 6:05 Australian Standard Time. And I don't know what time in Perth, but some other time. So see you soon. Cheers, guys. Bye-bye. Thank you for listening. I'm grateful for all our listeners around the world. If you found this podcast valuable, please share with someone that might find this useful. And please join our tribe of purpose-driven investors, increasing income and impact in our Facebook group, Positive Property. Please note, with a multi-million-dollar property portfolio and a passive income, I've become incredibly successful in investing in property. The fact of it is, however, many people may find investing in property challenging. It's not easy, and it takes a lot of hard work. However, becoming educated to make an informed decision and having the right advisors gives you the tools you need to succeed. The most important part of this formula, however, is to actually take action and apply that knowledge. It is important to understand the information I share is of a general nature only and is not taking into account your unique circumstances. If you're considering investing in any asset class, you need to seek the advice of an independent professional advisor who will be able to look at your specific situation. Be sure your advisor has actually achieved the kind of results you're seeking. Many won't have, so beware. We've taken great care putting those educational resources together. We'd be surprised if you didn't find any errors or omissions. If you do, our legal team says we have to say we're not responsible for those. In fact, as with all things, even your success, we're not responsible. That responsibility always has and always will come down to you and the actions you take. We're passionate about supporting you in that process and helping you increase your ability to create wealth, live the life you desire, and provide all the things you dream of for you and your family.